EV/EBITDA has become a popular metric for getting a quick snapshot of the real value of a business. But what does it mean and how can it help us? First, let's start out looking at the EV portion. This is the enterprise value and is a more holistic representation of a company's value than just market cap is. While market cap is just the number of stocks out on the market times the price of the stock, it doesn't take into account things like debts or cash flows like enterprise value does. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. This metric is easy to calculate from the financial statements and gives us a good idea of a company's financial performance and health, especially focusing on factors that are in the company's control, like operations. So if we divide EV by the EBITDA, it gives us a good metric for comparing companies within similar industries. A lower EV to EBITDA is generally better for investors, and below 10 may indicate a great value. One of the strengths of this formula is that while EBITDA can be a victim of creative accounting practices, the EV to EBITDA ratio can show us if the company's having cash flow issues. Another strength is that while tax and depreciation laws vary from country to country, the EBITDA sidesteps all of those differences. So this formula can be useful for comparing competition across borders. The flip side of that is that, especially in certain industries, having a clear understanding of the tax and depreciation will be key, particularly in industries that require massive outlays of investment on large assets like manufacturing. As usual, it's important to use this metric alongside other metrics too, including ones like the PE ratio and the PS ratio, and looking through the financial statements as well. And most importantly, don't forget to stay generous. I love you guys. Let me know down in the comments section if you have any more questions, or we can chat over on Patreon too.